Welcome to Value Investing webinar. Today we are going to talk once again something which is quite familiar. Should you invest in value fund? And with me is here Harshad, who is responsible for delighting investors at Quantum Mutual Fund. Value investing, as you know, is all about finding a deal, is about spotting an opportunity which is attractive, the worth is more, and you are getting it at a discount. And how does it translate into a strategy, and how does it translate into a product called mutual fund? Value funds got created as an independent category. Ever since SEBI created a new category of value funds since the reclassification exercise, we have a peer set. There are funds which claim to be value fund, and they are nicely kept in that category. Value funds can go anywhere. Value funds, they are not small cap, mid cap, multi cap. Otherwise the yardstick to measure or classify a fund is the capitalization, how big the underlying companies are, or different strategy. Value fund could be of any kind. So, good that, you're here, Harshad. I would like to understand, how do we explain this concept to the naive investor who is still, most Indian investors are still stuck in that fixed deposit, PPF, that is their starting point.
Right.
And then when you have to tell them about invest in equity, and then explain something which is even more sophisticated.
Right.
If you have to explain somebody who has no idea, what is a value fund in terms of experience, how will you explain it?
Yeah. So we face this very frequently because what we have seen is people are so used to investing in the growth style when it comes to an investor.
Even when investing in funds.
Even when an investor who knows what is mutual fund. One of the best way we put forward is, let's take an example. There's a growth fund and there's a value fund. And it's year one of your investment where the funds are doing well. Equity markets are doing well. Like a absolute bullish phase.
2017,
yeah. Okay. And when the markets are running well, let's say the growth fund went up by 90%. And the value fund moved at around...
90% is 2007. Maybe, 2017 is, of course, small caps, the average went up by 50%.
Mid-cap, small cap did. Sure. Okay. So, leaving aside the market cycle.
Exact time frame,
yeah. So let's say that there is a growth fund in year one, which is a bullish market, went up by 90%. And there's a value fund, which went up by around 45%. Okay. Come year two, when the markets become nervous, the cycle turns around. The growth fund, which has gone up by 90%, comes down by 75%. And the value fund, because the way it is being managed, and there is a possibility in a running market, the value fund would have moved into cash
as
well. The markets come down. So on the value fund, you see that value funds will come down by around 50%. Now, just put a maths behind it. If an investor would have invested 10,000 rupees in a growth fund, that would have gone to 19,000 and then gone down by 75%. So that 10,000 worth would have been around 4,750. In a value fund, the 10,000 invested would have gone up to 14,500 and will come down by 50% to 7,250. Now, when you try to explain, the investors in this way, that's where, they really find value in the value fund. It makes sense. What you're saying.
But it's a very difficult thing, because I understand the challenge, because if you tell somebody that invest in an equity fund because your money will grow faster. But then at the same time, you say that you will lose less. And you will actually gain less. I think it's quite a challenging thing. So tell me, once you have explained this value concept and what investors should be experiencing or expecting, when does an investor get most anxious?
Investors will typically get anxious when the markets are, running. They want to participate. And, when the markets are coming down, you'll see that, there's nervousness.
The big fall and big surge is when investors get anxious.
Or probably,
so what is the typical investor's reaction? If the market has gone up, do they want to invest or do they want to take their money out?
So when the markets are going up, of course we deal with both set of investors, but there's when the markets are going up, people say that, "Acha, aap mujhe batao ki aur main kab dalu?" Aur kab dalu?
Good time to now.
Is it good time to put money? Good time to put money. Because the perception is market have gone up to this level, it could go up. I don't want to lose this opportunity. That's the thought process. Then comes the second phase where, the markets are coming down. That's where the nervousness starts.
People get
I see my
scared.
money, and the people get scared, and I see my money coming down. That's the phase where we need to explain people that it's an opportunity rather than be scared and come out of it. And we have seen that. We have seen people trying to stop their SIPs when the markets are coming down.
Okay. Not take their money out as much.
Yeah. And our thesis, I'll give you a small example. Post Lehman, we were one of those guys who were running out in market and advising people to, this is the time to invest. At that time, we used to get answer, and Harshad, the markets have come down to this level. Wait for 3 months. The market will come here.
Yeah. Okay.
Acha, theek hai. We waited. Then we went back saying that yahan tak aa gaya hai. Ab please put money. Answer is no, it will come down. So it's like people try to waiting. Keep waiting because that nervousness is still there. But in the meantime, then what happened was the market turned around, and the opportunity to invest at a lower level was lost. The same investor would have invested maybe 6,000-7,000
points
higher. So that's an opportunity which is lost.
Tell me about India is a country of young people,
right?
And how do young people behave when it comes to talking about investment, and what is their anxiety point?
Yeah. So, fortunately, we have been doing a lot of path to profits where we come across youngsters also. People
who are getting started with their job.
Yes.
Okay.
Yes. And I'll try to.
What do they do?
Yeah. So I'll try to give you I'll try to explain or narrate you an incident which happened at one of the path to profit, where I came across and met a very young investor, probably around 26, 27, just started, to understand what is equities, but has been earning post graduation. So probably that the guy was
working for a couple of years,
for almost good 3-4 years. And when I was discussing with him, I noticed one thing, that he has always been parking his money in the debt side, as fixed deposits or savings account, or the habit of PPF.
Okay.
Then he came to know about mutual funds and equities, and he was there to understand more. So there is curiosity. They would like to know what should I do. But at the same time, probably the way we are cultured in terms of savings. We have always been said, it is better to be safe rather than, and equities hai, stock market hai, to danger hai. So probably he came from that kind of a background. So it took a while for us to make him understand. So probably to the best of my understanding, I remember that we took around half an hour post path to profit.
Okay.
Where we started explaining, why equity should be a part of your portfolio. Not that equities are.
So what you're saying is that youngsters are saving. They are curious. They don't know what to do.
Yes. And
they need hand holding in terms of how to navigate the equity investment for the long term. Okay.
Yes. So one of the perception that some of us have is that youngsters are spenders. It may not
and
be.
they are.
They
simply have more spending avenues.
Yes, they are. But what we are saying is they do have. There are a few youngsters who would like to know more and save more. We come across people like them a lot.
No, today if you have avenue to buy your iPhone on an EMI, then you are effectively spending your future income.
Yes.
So it is negative investment.
Yes.
What you will earn in future is what you have spent today.
Absolutely.
So in that sense, we have those youngsters and those aspirations. So are they're very confident.
Right.
They have all the spending avenues too. Right. And the easy credit available.
Yes.
So that actually is a fight. That actually is a struggle. But there are people who are saving. They're curious. They want to invest, and I think they will set up.
So they may not get excited. They may not get excited by a retirement thought process right now, but there is an eagerness to know how do I create more wealth. They are not seeing their money grow just by parking in fixed deposits or
enhancing return.
They would like to enhance return, but at the same time, that culture of taking risk or a calculated risk.
Tell me about your experiences with somebody in his middle age, in his 40s, worked hard, saved, and what is their typical question? How do you deal with them, and how do you find them in terms of their ability to comprehend what equity is, what value fund is, the ups and downs of the market, or the disbelief in market is is a den of thieves or traders or speculators or something like that?
they don't consider market as thieves or.
But a good part also understands that it's a place to speculate. Satta hota hai yahan pe, or
Yeah. So what we are seeing right now is that there is this age group of middle-aged people with responsibility are the audience who wants to participate in mutual funds or who are already participating in mutual funds. Predominantly salaried people. Okay. Everyone have a life goal, and that goals are multiple. They also understand that mutual funds could be one of the way where you have these, where I can take care of my retirement, I can take care of my child's education, I can take care
multiple goals. Any long-term
goals can be taken care. Where we come in picture is probably these investors would have always seen about a growth style of a fund. The knowledge on the value style is increasing.
Okay.
But we Quantum Long-Term Equity Value Fund being one of the oldest value fund in India. Okay. And post categorization, it's very clear that there are only few value fund. There is a keenness to know more because they also see your long-term performance. And over a long term, you place long-term equity value fund compared to a multi-cap or a large and mid-cap, you will see that it's absolutely comparable. So in that case, there is a curiosity, and that's where we come into picture, and that's where we have to explain them how do we manage the fund. Most importantly, why this fund makes sense to you is because it's not only the upside that you look at, but also it's a long-term investment. When the markets turn cycles up and down, this fund will go along.
Withstanding a decline.
And what we put forward to these kind of investors is that keep in mind what your financial goals are. When you are nearing your financial goals, and particularly if in case you have invested in mutual funds and long-term equity value fund, before you reach that one goal, 2 years before that goal, start doing a SWP. Because that's where you start de-risking your money from that.
What has been your experience with what is being said about old people in India, that they're completely risk averse? How do old people, people in retirement or people who are approaching their retirement, who are about to retire in a couple of years, how do they respond? What has been your experience with them?
So, one is that, all retired people are risk averse. It's not true.
Okay.
Because fortunately, we have a lot of people who are about to retire or who are retired have created a very good corpus for their retirement.
So old-time investors have experienced it and they know it.
Okay. But yes, there are a set of people who still believe that I can save my money right now and then I will use it in future.
Okay.
So I'll tell you a very good example of what happened in one of our discussion with a senior citizen. We came across a senior citizen who wanted to take care of the retirement, and there is a risk. The risk was that the investor believed that whatever that person has saved is good enough to take care of the post-retirement period. So that's where, and typically we have been said, right? Or typically we keep on saying that if in case you are nearing your retirement or you're retired, pull out all your money from equities.
And put it in fixed income.
Fixed deposit or fixed income. And there was a risk that, the investments, wouldn't have been sufficient for this person to take care of.
To support his life.
So it could have been, he would have outlived the investment. So here comes the phase. So that's where we started our discussion. And I started explaining that there has to be some allocation into equities. And why a fund like a Quantum Long-Term Equity Value Fund makes sense for that kind of investor, because even though it sounds conservative, but it delivers.
It is conservative.
It is conservative. It delivers the returns what is expected from equities over a longer period of time. So we made a mix of fixed income plus your multi-asset and a long-term equity value fund. And we planned out that way. And that's basically because your long-term equity value fund could be the engine for that investor to take care of their.
So investors are willing to, even old investors in their retirement are willing to understand that to reduce the possibility of outliving their savings, they need to invest in equity. And they're buying that idea.
They are. And I think they've started strongly believing into it. They've started strongly believing into it.
Thank you, Harshad, for sharing your perspectives on this, your experiences. Now we get on to the questions. Tushar is asking, does fund size matter in case of value fund? At Value Research, we get plenty of questions about all the funds which are getting bigger. And people say that, will the fund be able to repeat the magic? Because all the magic was done when the fund was small.
Absolutely. So one is a myth that a smaller fund cannot perform as a larger or bigger fund. And you're bang on when you said the opportunity is equal. The issue comes in when the fund becomes oversized. And that's where, the subscriptions are stopped by various asset management companies and those funds.
Stop taking money.
Okay. Yeah. So the size of the fund doesn't matter, when the fund is small or when it even is growing. At a period when it becomes mid-size, and when it becomes oversized, that's where it becomes an issue.
I'll just add my, tail into this answer, that there are funds where big is better. For example, liquid funds, bigger the fund, better. Index fund, bigger the better. When it comes to a small cap fund, when it comes to maybe a value fund, for a small cap fund, maybe a 2,000 crore fund could be big enough. For a value fund, maybe 10,000 crore could be big enough, because many a times you will come across value opportunity, which will not have a proportionate impact on the fund. So the scale matters. And in some cases, big could be good. And in many cases, big could be bad. And so there isn't a straight answer. So to say.
Yeah.
Sundar is asking, why are NAVs of regular and direct plan of the same fund different? Oh, this is a fairly mechanical exercise. Direct plans charge lower expense because they spend less on the commission. They spend less there, the regular plans have, the NAV of regular plan, they deduct the daily expenses, and which also includes the mutual fund commission, the commission paid on selling that fund to you. Direct plans are bought by investors directly. They do not include the sales commission. So they are lower. That is why typically the direct plans, or mostly the direct plans NAV is higher, because there is a less daily deduction on account of the expenses. So now the next question, Pulkit is asking, and this is a very specific question to you. Do value funds work in a specific market cycle? Your fund does well only at a certain time?
Not really. So one is, value fund
they do well all the time.
Yes. So value funds are...
But you just said in your initial example that when market is going up, value funds struggle.
Right. So I'll just try to explain you. Okay, I'll just try to explain you how does it work.
I'm not trying to corner you. I'm just trying to understand the context of this.
Yeah, sure. So and it's a valid question even you are trying to put forward, because we come across these questions multiple times. So one is, value funds are absolutely long-term funds. Okay. There could be cycles where, if the market goes crazy, the value fund will go along with the market, and when the valuations start becoming expensive, that's where very stretched, the markets will go up and we'll start trimming the portfolio. That is where the cash level increase. And that's the moment probably someone will feel, value fund is not good for a rising market.
Well now.
Yes, for a rising market. But that's what it is expected. When
market becomes risky, you turn conservative.
Exactly.
And that is why you do poorly.
Exactly.
At the fag end, but you could be wrong. The market could be expensive and remain expensive for a long period of time.
There have been multiple cycles from the time we have launched the fund. Okay, you can take a classic example of Lehman. Okay, post Lehman, quantum long-term equity value fund.
2005-06, you would have struggled.
We have underperformed, and then post Lehman we were one of the best fund. And then there's a reverse. I would like to explain one more thing, that just before May 2009 elections. It was anticipated that that's when UPA 2 came in.
Yeah.
There was an anticipation that, it would be, the situation was similar to what is happening right now.
Yep.
Okay. And the markets were nervous. Our cash levels were marginal, very less.
You're fully invested.
We were almost fully invested. And then, UPA 2 came into power. And market shot up. From that point
on. 1 day gain of the significant thing.
Absolutely. And it triggered off
7-8% gain on the market in a single day.
Correct. Yeah. Correct. So it is, so we at Quantum are very clear. Okay. Irrespective of what is index level, who is in the power. Most important thing is which company do you invest, and if the valuations are stretched, come in, cash and wait. So this is 2009, which was
So
reverse
you are
of what
all
people
about
think.
being fully invested when you find companies are reasonably priced.
Absolutely.
Be in cash when you don't find them to be attractive.
Yeah. Because then there is an opportunity when the markets come down. Okay, there's an opportunity to deploy. We have seen.
You'll be able to buy cheaper.
Absolutely. Absolutely.
Another question, which is, which I think is representative of many questions. This question comes from Anand. And I have a small capital to invest. How can I safely start investing without risking my capital?
So Anand, it's a very good question that you have put forward. It is very interesting to know that a lot of people are showing now interest to invest into mutual funds and equities. So it is always good to start with a smaller amount, test it out. What we have seen is a lot of investors start in the initial stage of their investing. They want to invest into equities, and for them, equities is like quick win. And they tend to invest into mid caps. They tend to invest in small caps.
So exciting funds.
Yeah, and they're like, I want to run fast. Okay, and then comes a phase.
Why not? He's a young guy.
Absolutely young guy, but then there will be a phase where the markets, in case the markets cycle changes, and then to see my amount or my invested amount getting negative day by day, there is a possibility that the investor will pull out that money and then in future never invest into a wonderful asset class like equity through mutual funds.
Sure.
We'll lose out the opportunity. And it's not just restrict to that. It'll also trickle down to friends, relatives, and maybe next generation.
The word will spread.
It spreads.
हमने हाथ जला दिया तुम मत करो यार. To lose money.
Right. Okay. But I would say, Anand, it is good that if in case you want to start off your investment with a sort of a balanced fund, or if in case you can also certainly look at quantum long-term equity value fund.
It's a conservative.
You can say it's a conservative value fund, but it has, again, I'm repeating that it has delivered returns over a period of time. And with the expectations of returns similar to a multi-cap or a large and a mid-cap, you can certainly look at a value fund.
Sure. Anand, I would like to just add to that answer, which is start your SIP and invest for the next 5 years and don't look at the value every day. You'll be taken care of. So that is, that's crucial. Investing your money, which you are unlikely to need for 5 years and more. Now, Bhuvan is asking that, is the current market situation good to make fresh investment? Now I have to answer this. Equity investing is all about, it'll be great if some investors are able to buy it perfectly at the bottom and sell it perfectly at the top. But it is easier said, never done. And in my 30 years of running value research, I can tell you with great confidence that no mutual fund manager has been able to take a view on the market and has been right. So don't attempt to do that. Current situation of the market, nobody knows. We only know about the past. We don't know about the future. But generally speaking, investing in equity is a general bet on better future for us over a period of time. Things are improving. Companies improve. Some companies die, but most companies change, evolve. And so with that in mind, it's always a good time to making your investment. The three things which I said in the context of Anand's question, that invest your long-term money, be a regular investor so that you are not taking a bet on the current state of the market, and invest with confidence. If you are going to, based on the very basic premise, not economics, if we are going to live in a better world, then investments will do well. And that is the key premise why you should be investing in equity. Be the owner, not a lender. Yeah. So thank you very much, Harshad, for being here and sharing your thoughts and your experiences with a wide array of investors you come across, particularly the youngster, the middle-aged, and the old people. I didn't know. It was quite a revelation that old people are willing to and listening to the idea that in their retirement they should be investing in equity.
So there is, because there is a possibility. So there is no social security in India, right? They know very well, that they will have to take care of their retirement.
You have to provide for yourself.
With families becoming more and more nucleus, you cannot be dependent on your next generation to take care of you. That's what I think that's been understood. Yeah. So there is an interest. And I think they have understood that we need to park some allocation or some amount in equities, which will help us that money to grow.
Yeah, sure. To beat inflation. Yeah, sure.
Yeah.
So thank you once again for being here, and join us next month again for Value Investing webinar.
Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.